In this video, traders, we're going to look at the time zone of the open where you get the most crazy prices. Stay tuned. Hey guys, warm welcome to you. All right, so the open is a really volatile time at the best of times. On a normal open conditions, off we go, the bell goes, and all hell breaks loose. Why? Because you've got a lot of order flow that's coming in. The specialists are trying to sort them out. You've got opening orders and auctions and other exchanges. You've literally got a lot of people who are doing a lot of business. And the open generally is where the most volume is done. Volume is kind of looks a little bit like this. So at the open you have a lot. It kind of tapers off about lunchtime. And then sometimes you get a bit of a spike into the close. And that's more the traditional type of thing. Sometimes you get a little bit higher, but it's kind of like a little bit of a smile type shape. So what does that mean for us as traders? What it means is under certain conditions, you get significant overextension at the open. And as a trader, as a day trader, your job is to identify overextension and fade those moves for a mean reversion kind of short-term plays. Or at the very least, not get sucked into chasing these kind of things. So some examples today, guys. Background for today, news came out of a effective virus. And long story short, the market thought, okay, great, that's going to make some of the kind of traditional stocks that were getting hammered, like the retail stocks, like the cinema stocks, the airlines, that kind of stuff, should spike. Well, Disney spiking because they can open the parks back up again, even though they're kind of somewhat hedged with some of their online offerings. Forget that for now. Spiking up, good. They've got the cruises, they've got the parks, etc., etc. And the stocks that were benefiting really well from lockdowns and stuff like Peloton, like Zoom, the work from home stocks that I call them, were getting slammed. So you had this scenario where whenever you get a big gap, a significant gap, you have to be very careful. Now, gaps come in kind of three different categories. You've got the meaningless gaps. And again, this depends if we could be trading SPY, we could be trading Qs, we could be trading stocks. Less so for currencies, obviously, because the gap's only at the weekend. But you have like meaningless gaps. They're just a few cents, a few base points. They're nothing. And that's just basically the market telling you we don't care. The difference between the open and close is very much the same. It's just noise. And you're not interested. And if you start to treat it like a gap, then you're going to get caught out because it's not really a gap. Then you get the kind of mid-level gaps. And the mid-level gaps are where you kind of maybe gap out the yesterday's range. So you gap above the high, you gap below the low, or maybe you gap a decent enough amount if the yesterday's range was quite large. And you go, oh, you know what? Well, actually, there's some action going on there. There's quite a bit of a reprice scenario. Maybe there's a gap fill to be had. Maybe there's a continuation. And there's a few trades that kind of open themselves up when you're in that situation. I think I've done a video on that before. But if you wanted me to cover that again, guys, and let me know in the comment section below. There's some nice strategies that maybe will help you out with gaps that I've got in my kind of toolkit. And there's another gap, which is just what I call a stupid gap, a ludicrous gap. Not ludicrous mode for you Tesla fans out there. It's when you get a scenario where the price gaps so much based on some news, whatever that is, that everyone is just watching it. Everyone's either running for the door because they're wrong, or they're diving in because they're right, or they're desperate to get in because they think it's going to fly. And that's when you've got to be careful. And today was one of those ludicrous gaps. We saw some gaps in stock and moving stocks that were just insane for the news. For Peloton, for example, dropped 25% of its market cap. I mean, I get that Peloton might well struggle in this argument to say it's overvalued and all this kind of stuff, but 25% seems like an awful lot for a gap. If it had done it over a multiple period of days, you say just what it is, guys. It's a kind of high beta stock that's just getting its hair trimmed off. But when you get significant gaps, same with Disney, big stock like Disney gapping up significantly, at the open are your opportunities. And generally speaking, you've got the first 3 to 5 minutes to do something to fade it. I'm always very, very cautious, and I've learned this the hard way, guys. I know I've learned almost every lesson there is to learn out there. That's not the right thing to say. I've learned a lot of the lessons going through. I'm sure I've got lots of lessons to learn as I continue my journey, increasing my trading size and on the pathway that I am. But the point is, I used to be very eager to trade in the first kind of couple of minutes. And that would always be very volatile and you'd end up getting caught out. The sweet spot I found is the 3 to 5 minute period for fading extreme moves. So when you get an extreme move like you saw on Disney, 3 to 5 minutes, there's your 3 minutes, there's your 5 minutes, is your place where you look for your mean reversion. Now, you're not looking particularly for anything home run here. You're just looking for, wow, it's a big gap, and wow, it's even more extended. You know, this one went from 140 to 148 in 3 minutes. Wow, let's see if it can at least find some sort of neutral ground here. Same with Peloton. Actually, I did trade Peloton today, but there, you know, 5 minutes is about right. 1, 2, 3, 4, 5, and then it goes, okay, this thing's down a hell of a lot. You know, probably due some unwinding. There's a mean reversion play in that. And it's the same with kind of the other things like Zoom. Again, the stocks that are getting hit the most. Look at the thing. 1, 2, 3, 4. In the 5th minute, you're basically talking, wow, this is a little bit too far, a little bit too much. And even stuff like Doku, you know, 3, 4, 5, there's a little bit later. But around the 5 minute, if you kind of start to fade it around the 5 minute level, you weren't far off. The point is, guys, is that be very careful in the first few minutes of trading. Be very careful that you don't think, wow, this is too much too soon, and start to fade moves too early. Because when there is order flowing in at that aggressive rate, you've got people who are stuck and they've been margin called. There's one thing, the brokers that don't care what people are getting out at. If people have been margin called because they've got a portfolio of stocks that as a sector is getting hammered, the broker says, I don't care, I just want to get everybody out and whatever price that is. And so also others know that, so they're not going to be bidding aggressively. So let that flush through first. Let the first 3 to 5 minutes kind of transact. Let it find a level. And then if you think there's an entry and you can start to see some stability and you can start to see some buying settling and it not going down so much, then obviously with all your risk management and all the other stuff that comes into play with taking risks like that, then in my opinion and in my experience, that's a better time to look for that counter trend kind of blip and move. And we had that as well when we go back on the coronavirus hammering, when we saw that information coming out back in March, especially in the UK stocks. Lots of kind of scenarios like that. Margin calls, people getting stopped out, markets moving aggressively for the first 5 minutes. Then they find a little bit of common ground. Then they relax a bit. Then you get a mean reversion play. Now listen, if later on in the day it goes to new lows, that's a different scenario. That's something you can play for. So don't chase stuff too early on. If you're looking to fade it, just give it a little bit of time. Just wait a little bit. Let it run, let it run, let it run, let it run. Think about the people getting margined out of it. Think about the people getting stopped out of it. Let them come through the price first, and then you step in. And yeah, if you get stopped out, you get stopped out. You're still going to have a stop, guys, because these things can just fall for the next 20 minutes. But that's a better bet, in my opinion, and again, in my opinion, than kind of diving in very, very early on. All right, guys, take care. See you next one. Bye-bye.